Yo guys, what's going on? Welcome back to day 6. This is about equilibrium. Also another super easy concept just like order blocks. And I know, bro, I'm finally getting on my grind. 2 videos in a day, bro. What? Or not in a day, but back to back, day for day or whatever you call it. Yeah, bro. Crazy. I know. I'm finally taking some responsibility. But let's get into it. So what is equilibrium? Or as most people call it, discount and premium. So everyone's familiar with the concept that you buy low and sell high. Right? If you're having uptrend, obviously you're going to want to buy here and sell up here to make a profit. Why would you want to buy here and then sell here, right? You don't make as much money. And conversely, if you're on a downtrend, you want to sell high and buy low. So the whole point of it is equilibrium tells you where the low is and where the high is. What is the low and what is the high? Where do you want to buy and sell? And so the metric that you use to actually determine this is you can either use a Gone box or a Fibonacci retracement. I don't really use Fibonacci. I use the Gone box. It's easier for me. What you end up doing is you create this Gone box on the most recent low and the most recent high. And so if you're on an uptrend, you're going to start the bottom of this box at the most recent low, which is going to be here, and at the most recent high. Let's actually make this high. There we go. And at the most recent high, which is going to be up here. And you're just going to put it there. And obviously, your Gone box is going to look a little bit different. So you're going to want to go into the settings and only have on the price levels of 0, 1, and 0.5. And then you can set these colors to like whatever you want. But you don't even need the colors. You can just turn that shit all the way down or just disable the background. But essentially, whenever you mark out the most recent low and the most recent high, all it's really highlighting is whether or not price is above the 50% level or below the 50% level. And we call this the premium and the discount. Premium, discount. And so whenever we're looking to enter off of an uptrend, right, we're expecting price to keep going. What we're hoping for is price to enter the discount range, which is anywhere from the 50% level and below. Enter that range, and then that is what tells us, okay, we're good to enter because we're in a low. We're buying low. We're buying whenever the price is discounted, right? It's like you go to the grocery store and they put a discount on the product. Why would you want to buy the product without the discount whenever you can wait for the product to go into the discount and then buy it? You're saving money. And especially the market itself, it's literally all about money. The only thing there is higher prices or lower prices. So obviously you wait until it goes to the lower. And then obviously if you were looking to short, let's say you were in a downtrend, you do the same thing, except you would set up your Gone box at the most recent high to the most recent low. And then in this case, if we're looking to short, we're obviously waiting for price to go back into the premium and then enter anywhere in here, and then we continue to trend down. So it's literally just marking out these retracements, finding out, okay, it's a good price to buy whenever it goes above this level, and then we enter. And so that's literally all it is. And so you can see this happening all the time on the charts. All right, my recording just crashed. I don't really know what happened. But anyways, I was going to show you guys some examples. I didn't get that far before it crashed, so we're chilling. But let's look at the charts, all right? Let's actually put our theory into practice. So what do we see here? We have a low form, which this is going to be our low. Let's pretend that this is our most recent low, to the next most recent high, which is right here. What do we see happen? Price ends up going back into that discount and then going back up through the premium and obviously continuing its move up. Then what do we see after? We take our high. Now we have a high going down, right? We're high to low. So let's say you were looking to short this. You would go from your most recent high to your most recent low. Price wicks into the premium and then continues to go down through the discount. So it works both ways. They converse each other. And it's literally that simple. I mean, it's as simple as that. You just mark out your low to high, wait for price to retrace, and then enter. So let's go ahead and look at another example. Let's say a little bit later, we're looking to take a short. What do? We go from our high to our most recent low. This is our most recent high. This is our most recent low. Mark out price. What does price do? Wicks into the premium before continuing its move down, going down the discount, taking out liquidity down here. So let's do one more example, and I'll show you guys how you can actually enter these. So we have a low form to our high. Price wicks into the discount and then takes out the premium and then continues its move up, creating a higher high. So let's say you were to enter this trade, you'd want to scale down time frames. So we're on the 1 hour, we go to the 5 minute. We marked our high, which is here on the 1 hour. Any confirmation that you can find after this that correlates with our bullish entry on the 1 hour, we'd be looking to enter into that. And I mean, bro, like this is so obvious. Look how long that wick is, bro. Price obviously had to take out into that discount before continuing to move up. That shit is so obvious, bro. Look at that wick. And then it pumps back up and then pumps back up and takes out this high. That doesn't show you that that's literally what price is doing, then I don't know what will. And so this giant wick is literally also an order block. So we can take that, make our order block, drag it out, see price enter, react off of it, that could be our entry. And so you can set this up for long, enter right here. Stop loss is going to be below our equilibrium. Take profit, points of liquidity. Let me actually show one more example. Let's go ahead and I'm on the 5 minute. It's still like a small time frame. So for example, actually over here, we see our most recent high to our most recent low. We mark it out. What does price do? Taps into the premium and then continues its move down. Scale down time frames. Let's go to the 5 minute again. What do we see? What do we see? Holy shit, my chart is cooked. We see from our low, we see a bearish fair value gap. Mark it out. What does price do? Taps into the fair value gap before continuing its move down. So obviously on the 5 minute, it's like a lot more noisy. But yeah, you could have entered down here, seeing it enters the bearish fair value gap. And so that's a confirmation. Order block. Taps into the order block. Dumps. That's another entry. And so you probably would have just wanted to enter off of these wicks that keep on popping back into your fair value gap or your order block. And so we set up the short. Let's say we set it up here, I don't know, after the order block. TP or stop loss, because it's such a big hourly like move, you could have set it outside of the fair value gap if you wanted to, or if you have balls, you could have set it all the way above the equilibrium. I'm going to set it outside of the fair value gap. TP, points of liquidity, either here, 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 low down here. But in my case, I would have just set it like right here, or actually, you know what, right here would have been fine too, because it's a pretty prominent move. So what the fuck just happened to my thing? There we go. And so all that shit gets hit. Let's change pairs. Let's go to the Nasdaq. Good old Nasdaq. Nasdaq in my ass crack. What do we see? What do we see? What is it that we see? Low to the high. Price taps into the discount and then moves up. And then we'll do the next one. So what do we see here? Now we're going from a high to the low, most recent high to the most recent low. Price taps into the premium before moving down. And what do we see in the next one? The most recent low to the most recent high. And I'm just going to delete the old one and that one too, because it's getting in the way. Price taps into the discount before continuing to move up. It's like super tiny moves, but I'm trying to show you guys that like it happens over and over and over again, because prices with such liquidity always seeks the most efficient price. Price is always trying to be as efficient as possible. So this just keeps happening and happening over and over again. And especially on a higher time frame, it has much more conviction. And so you could literally just sit here and do this all day. And especially like whenever you zoom out, you can especially see it. Like on all these moves that go like up and down, you can literally see, like if you zoom out, okay bro, what is this? Higher time frame, obviously like you'd have to go from the 1 hour to maybe like the daily or something. You can literally see from the low to the high, goes down, taps into the discount before pumping up. And so honestly, this wouldn't even be a daily move. Maybe this would be like a weekly move. Yeah, weekly low to weekly high, taps into it, and then continues to move up. Like you could literally find a weekly equilibrium, hold that shit forever, and then just get some crazy gains. What do we see here? Let's get another bearish example, I guess. We go from high to the low. There we go. Fixed it. What do you see happen? Price wicks into it before the move down. And actually, no, this one might be a little cooked too, because it kind of like went through it before doing it. But let me find one more example. Let's do this one right here. High to the low. Price wicks into it before moving down. Price wicks into the premium before going down, pushing through the discount. And if you wanted to set up a trade on this, you go down to the 5 minute, scale down time frames, find your optimal point of entry, bearish order block, put it out, taps into it. I hope it freaking tapped into it, bro. It's crazy. What the hell? Yeah, like barely tapped into it, but nonetheless, bro, you see something react off an order block that close. I'd pray and hope that you'd enter that. But as you can see, we have our bearish order block, taps into it, dumps off. And so you see that candle close, you would probably enter off the next candle, short, enter. We have to be more realistic about this. So we're going to go to the next point of liquidity, which is going to be here, or down here. Sorry, down here. So obviously for me, I would do next point of liquidity. So I would do it right here. And what is that? That's like a 0.86 RR. So that's kind of cooked. So honestly, I wouldn't even like that. I would probably take it lower then. I'll go like right here. Yeah, with this wick. And even that got hit. And so that's a 1 to 2. Or, if you wanted to do the hourly play, you could obviously set up the short, tear off this, stop loss outside the order block, TP first point of liquidity down here or up here. It's up to you. I probably would have done it right here, and that would have hit take profit. This would have hit take profit. This would have hit take profit. So, I mean, yeah. But yeah, that basically wraps up this video on equilibrium. Short, simple, literally you're marking out the most recent low to the most recent high, dragging out the box, and then waiting for price. Obviously, if you want a long, you're going to wait for it to go into the discount, and then enter, takes out the premium. Or if you're shorting, you want to wait for it to go into the premium, enter, takes out the discount, depending on whether or not you're in an uptrend or downtrend. So that's for this video. Next video, I think I'm going to be covering inverse fair value gaps, or so maybe, yeah, I think I'm going to be going inverse fair value gaps, because it's about time you guys learn that. So stay tuned for that. And if you have any questions, I always answer in the comments. Join the Discord. It's fire. I post my trades literally every single time I trade, or something that I'm looking at, I'll put in the Discord. So you guys can join the Discord, see exactly what I'm entering. And I normally only do about like 1 or 2 trades a day max, New York Open. So if you're interested in that, or if you have any questions for me, join below, bro. It's free. You have nothing to lose. So I will catch you guys in the next one. Peace out.